If you've put money aside and you want to invest in stocks, what would be the best strategy to get good returns? This is probably one of the oldest questions that investors have been asking themselves, and there are actually a couple of schools of thought that you can consider. One is called value investing and the other one is called growth investing. Today I will walk you through what value investing and growth investing are about, also their historical growth performance, and also we will look at why would it make sense for you to invest in it based on your goals. My name is Greg Angelbert, I'm a life and personal finance coach, and I share what I know about personal finance and coaching on a cup of coffee to help you live a life of personal agency and also build your wealth. Value investing is an investment strategy that focuses on picking stocks which seem to be trading at a lower value than their intrinsic value. So value investors seek out stocks that they think the stock market and investors out there are undervaluing. So they believe that the market overreacts to good or bad news related to a stock, and that sometimes that makes those stocks move away from their long-term intrinsic value. And this overreaction gives you an opportunity to whether buy stocks when they have a much lower value than their intrinsic value and sell stock when they are overvalued compared to their intrinsic value. The idea was first developed by Benjamin Graham in previous century. And you might have heard about Warren Buffett and Charlie Munger as really big proponents of this investment strategy. And the key point here is this difference between the intrinsic value on one side and at what price a stock is being traded right now. To determine the intrinsic value of a stock, you can use many different methods. The most simple one is to look at the price-earning ratio. This you can calculate by dividing the current price in the stock by its earning per shares. Earnings here represent the net income of a company, and usually it's for the previous year. There are many other methods which exist. One of them is the book value, which is looking at the asset that the company has on its balance sheet. Or you can look at future PE, for instance, future price earning ratio. So there are many methodologies out there to determine the intrinsic value of a stock, and it can be quite confusing. What I believe is just one indicator is probably not going to make it. It's a mix of those different indicators together that help you to have a round view of the stock, the company that you're trying to invest in. Fieldtown with rule number one investing as I think a very solid methodology that looks at the company overall, and that you can find in the description here or here. You can take a look at his channel and you will learn the methodology that he's using and that I sometimes use. It's quite powerful. The bottom line with value investing is that you need to have a long-term view. You need to be patient, to be ready to buy when the stock is traded at a discount. You also need to do quite a lot of homework because you need to understand profoundly the companies that you're trying to invest in. Growth investors typically invest in growth stocks. That is young or small companies or even large companies which are growing at a much faster rate than whether the growth of the stock market itself or the industry in which they are trading. And growth investing is highly attractive to a lot of investors out there because on paper it can give you a much higher return, much faster returns than other type of companies. That is as long as those companies are actually successful. So one problem with those companies is that they're growing fast, but there's not a lot of history about the earnings that they've had in the past. Like for value investing, you need to understand the fundamentals, the economic fundamentals of the company you're investing in, particularly the projected growth rates. And people say that the past does not help you predict the future, but in some industries, having some element of the past helps you to understand better what the future could be. With those companies, it's very hard to understand what the future will be because the industries might be new and they might have like 5, 10, 15 years of existence maximum. So the work to be done here is to actually understand the trajectory of that industry in terms of growth and the trajectory of that company compared to its peers in that industry. And keep in mind that you will pay more dearly for growth companies than you would pay for value investing type of strategy. The PE ratio that we talked about before, the price earning ratio, is much higher for growth companies than it is for other type of companies. And the PE can change rapidly. Growth companies can stop being growth companies. If we take the example of Meta, for instance, the old Facebook, they were at a PE a few years ago which was around 30 times earnings. And now they're trading this year at 14 times. So it seems that maybe they're getting out of the growth part. The bottom line with growth investing is that you're living in the short and mid-term. That means that for the decisions that you want to take about buying, holding companies, you have to take into account a lot more volatility short term, because it is pretty hard to predict the future, particularly if there's no past to refer to. Does this video resonate with you so far, so you know what to do? And also make sure that you subscribe and put the notifications on if you want to receive more content like this. Also check out in the description other YouTube videos from other YouTubers who are talking about the concept of value and growth investing. The tricky part with historical performance of growth versus value investing is a question of definition. I have told you qualitatively what growth investing and value investing mean. But who decides which company fit in one category or another, and how long that categorization will last? The Center for Research in Security Prices in the US is creating an index to actually do this work for us. They use future long-term growth in earnings per share, future short-term growth in earnings per share, 3-year historical growth in earnings per share, 3-year historical growth in sales per share, current investment to asset ratio, and return on assets to select growth companies. For value companies, they use book to price, forward earnings to price, historical earnings to price, dividend to price ratio, and sales to price ratio. The whole detail of their methodology can be found on their website if you want to have a lot of fun looking at very complex formulas. So when we're looking at historical performance of growth and value, we can only look as far as these concepts have actually been existing. A good example is a Vanguard ETF, because Vanguard is existing on the ETF and following index type of funds for a very long time. And if we look at the two Vanguard funds which are for growth and for value, we can see the following performance. Since inception in 2004, growth has outperformed value significantly. So if you look at just the past 12 months, it has not. And if we look at a much longer perspective, then we see that the picture is quite mixed. Growth stocks tend to do well when the economy is booming and when there is a large amount of monetary expansion. But if you're very long-term investors, then value has a crown. If we look at the characteristics of growth and value investing, it is not really a clear-cut whether we should choose one or the other. The reason for that is due to the characteristics of the way we invest. One key characteristic is time, and particularly the time we have to look at the evolution of a company so we can assess it properly. To be doing value investing and assessment of companies based on value investing, what you want to have is minimum 10 years and more than that of performance of that company in a specific industry, because that will give you a better understanding, a much more solid understanding of its intrinsic value. When looking at fast growth companies, the only thing you can look at is not many years, so the past is not a good reference necessarily for the future. The second key characteristic is volatility. Growth stocks are inherently volatile because they depend on the news, they depend on the economic growth that there is quarter by quarter, and also on how much capital there is around. Value stocks are in stable industries which have been existing for a long time, so you won't hear a lot of news about them. You will not even know a lot of those companies, but they will provide dividends and they will be very stable in terms of the earnings and growth that you can expect from them. The bottom line is that both strategies, value or growth, are actually aimed at finding companies which have good value, and that's good future value. For growth companies, because they are in interesting and fast-growing industries and they are the front runners in that industry. For value companies, because you want to buy them at a discount, so you are more likely to have an upside if you buy them at a discount. Also remember one point is that growth companies don't stay that way forever. They will eventually become value companies or just normal companies. And the second thing to remember is that growth is actually part of value, because when we look at the intrinsic value of a company, we're looking at its growth prospect. Well, you heard me say that many times. It very much depends on where you are in your life right now and your life goals. A general rule is that the younger you are, the more you can look at long-term performance, but at the same time you can also take short-term losses. As we saw, if we take the last 20 years, growth has beaten value in terms of returns, but if we look at the longer perspectives, then value has beaten growth. So, possible strategy is to start with a portfolio which is more oriented toward growth when you're young, and progressively you shift some amount of money towards value. So, let's say you start with 40% which is based on value when you're in your 20s, and progressively you move that to 60-70% when you reach your 50s or 60s. That's just an example. I personally like to mix growth and value because I like the certainty and the stability of what comes with value, but at the same time I like a bit of the excitement and the possibilities that comes with growth. And I use the growth and value concept not just for stock, I use it for any type of asset out there. For instance, over long run, maybe bonds can be considered as some element of value, or even gold. And on the growth side, you can have examples like art, which has been growing pretty fast, or otherwise you would have crypto as something which is very volatile and also high growth, or P2P lending. Coming back to your life goals, make sure that you check what they are and you build what they are based on the money that you will need for each one of them. If you want to know more, you can check this video here and here, where I explain how you can build life goals and understand the money aspect of your life goals. I hope this video was useful to you to understand better what value investing and growth investing are about and how they can fit in your investment portfolio. Good luck with your investment decisions, and I look forward to talking to you more about personal finance and coaching on a cup of coffee next week.